Welcome back to the channel, everyone. In today's episode, we're going to be breaking down some of the biggest news in the market this week, including the ongoing antitrust scrutiny facing tech giants like Google and Meta, and go over Sony's decision to increase PS5 prices in several key markets on the back of tariff news. We'll also touch on the implication of China's recent tariff retaliation against Boeing and the American Aerospace sector, and we'll cover the dramatic market debut of Webull. This last week also brought the start of earnings season, which is a crucial period because it gives a snapshot of how companies have performed and their outlook for the future, which can significantly influence investor sentiment and market trends. We've had a few key names reporting this week, and their results could set the tone for the weeks to come, potentially leading to more market rallies or downturns depending on whether they exceed or fall short of expectations, and depending on executive responses to tariff uncertainty. This is where we get the real insights, the raw data, and the forward-looking guidance that can make or break investment decisions. We're going to hear commentary from executives in the financial reports and earnings calls on what they're forecasting for the companies and how they're navigating tariff uncertainties. After a volatile few months in the market with the recent market crash and ongoing tariff uncertainties, this earnings season is going to be a crucial window for investors into the companies that they own or are looking to invest into. This last week, we've had some major players step into the earnings spotlight. We've had a diverse mix of industries giving us a broader view of the current economic landscape. Here are some of the big names that have reported this week. First up, we had the big banks and financial institutions, Bank of America, Citigroup, and Ally Financial. These reports can give us insight on consumer spending, loan performance, and overall financial health of the market. Then we had a few key players in the semiconductor industry with industry giants like ASML and TSMC reporting earnings. These companies are the backbone of the tech world, and their earnings can reveal critical information about chip demand, supply chain dynamics, and future tech trends. These earnings results can be huge for the tech sector. We also had some key healthcare companies reporting this week with reports from Johnson & Johnson and Abbott Laboratories. These companies provide essential goods and services, and their earnings can offer insight into the resilience of the healthcare sector. And to cap off the week, we had Netflix. In the streaming world, Netflix is a key player, and their earnings provide insight into the streaming industry. Before we get started, let's talk about tariffs. With these earnings releases, you can bet that analysts are going to be grilling executives about the impact of tariffs. I expect that most of the executives are going to indicate that there is a lot of uncertainty at present, and that they're finding ways to work with the tariffs. We've seen tariffs being implemented, rolled back, and adjusted, and this is creating a lot of volatility in the market. Some businesses will provide reductions to guidance, and some will say that they aren't providing guidance or removing their guidance altogether. Here's my take. I do think that tariffs at some level are here to stay. There is a clear desire to bring back manufacturing and production to the US, particularly for key sectors, and to use cash inflows into the US to reduce the national debt. I also believe that companies are going to adapt. We'll see some of this later in this video. It takes a long time to decouple supply chains or change behaviors, so companies are going to need to be strategic in deciding how they respond to tariffs. I think that some industries are going to be impacted more than others, and with the tariffs, we will see a period of uncertainty in the short term, but I don't expect that we'll be dealing with tariff uncertainty 3 or 4 years down the line. A key takeaway for this earnings season will be how companies are handling and responding to these tariffs. Now let's take a closer look at ASML and TSMC, as their recently released earnings offer key insights into the chip market. ASML, a critical supplier of advanced chip-making equipment, reported its first quarter net bookings came in lower than anticipated. This figure is a key indicator of future revenue, suggesting a potentially cautious outlook in terms of immediate demand for their high-end machinery. While their revenue met expectations, the low bookings number is something investors will be watching closely for signals about the pace of expansion in the semiconductor manufacturing space. On the other hand, TSMC, the world's largest contract chip manufacturer, delivered a strong first quarter with profits exceeding estimates, showing a significant 60% jump compared to the same period last year. This robust performance underscores the continued demand for the advanced chips that TSMC produces for a wide range of clients, from smartphone makers to AI companies. It's worth noting that while TSMC's current results are positive, the company has also highlighted potential headwinds relating to geopolitical factors and trade policies, which could influence their future growth trajectory. So while TSMC is currently riding a wave of strong demand, the broader landscape introduces some elements of uncertainty for the longer term. Now let's break down some of the major headlines that have been impacting the market this last week. First up, we have a significant development in the ongoing scrutiny of big tech. On Thursday, a US federal judge ruled against Google, finding that the company illegally monopolized key parts of the digital ad market. Specifically, the court determined that Google's dominance in the tools used by websites to manage and sell ad space, known as publisher ad servers and ad exchanges, stifled competition and ultimately harmed both publishers and consumers. This is a substantial win for the Department of Justice and could pave the way for significant changes to Google's advertising business, potentially even a forced breakup of some of Google's ad tech operations. While Google plans to appeal, this ruling underscores the increasing regulatory pressure on major tech platforms and has likely contributed to investor concerns, as reflected in Google's relatively low earnings multiple compared to its Magnificent Seven peers. This case is separate from the previous antitrust case focused on Google's search engine dominance, meaning that the company is now facing a two-pronged legal challenge that could take considerable time and resources to resolve. Continuing with antitrust cases, this week Meta, the parent company of Facebook, Instagram, and WhatsApp, went on trial in a landmark antitrust case brought by the US Federal Trade Commission, which argues that Meta illegally built its social media empire by buying up emerging rivals, namely Instagram in 2012 and WhatsApp in 2014, in order to squash competition before it could grow. This is despite the FTC approving these acquisitions more than 10 years ago. This trial is split into two parts. In the first stage, the court will decide whether Meta violated antitrust laws when it acquired these two platforms. If the FTC wins this stage, the court will then move to the second phase to determine a potential remedy, which could mean forcing Meta to sell off Instagram and WhatsApp. The last thing that Meta will want to do is sell off Instagram and WhatsApp. These apps were once small startups, and Meta has since grown these businesses, driving user engagement far beyond what Facebook achieves on its own. Untangling them now would be an enormously complex and painful process, given how tightly their infrastructure and data systems have been integrated over the years. Meta argues that the company has lots of competition, like TikTok, Snapchat, Reddit, YouTube, and X, and that these acquisitions haven't impacted competition. Meta also argues that by acquiring both Instagram and WhatsApp, Meta has helped both apps grow in functionality and user base. The FTC argues that these acquisitions were not just smart business moves, but rather calculated strategies to eliminate future threats. Proving this, especially more than a decade after the fact, and after the FTC has already approved these acquisitions over a decade ago, won't be easy. Legal experts say that the case may come down to what Meta's executives were really thinking back then and whether those motives crossed the line into legal, monopolistic behavior. Shifting gears, Sony announced last week that it is increasing the price of its PlayStation 5 consoles in several key global markets, including the UK, more broadly across Europe, Australia, and New Zealand. Sony cited a challenging global economic climate marked by high inflation and fluctuating exchange rates as the primary reason for the price hike. Analysts also suggest that the recent US tariffs on electronics manufactured in China, where the PS5 is primarily produced, may be a contributing factor. Interestingly, prices in the US remain unchanged for now, but the global economic pressures and trade policies could potentially lead to a similar adjustment down the line. This marks the second price increase for the PS5 in these regions since August 2022. Turning our attention further towards global trade, tensions between the US and China continue to ramp up, particularly in the aerospace sector. China has recently instructed its airlines to halt further deliveries of Boeing aircraft and to cease purchasing other aircraft-related equipment from the US companies. This move is widely seen as a direct response to escalating trade disputes between the two nations. Major Chinese carriers, which had significant Boeing orders pending, are affected by the suspension. This development is a clear headwind for Boeing, as China represents a crucial and substantial market for its aircraft. Boeing's stock experienced a decline following this news. Boeing's European competitor, Airbus, saw a slight increase in its stock price, with investors thinking that Airbus could benefit from a potential redistribution of demand. Adding to the tension, China has also reportedly stopped exporting certain heavy rare earth metals, which are critical for various US industries, underscoring China's significant leverage in the global supply chain. Finally, we've got the recent rollercoaster ride of Webull. The digital brokerage platform made its debut on the Nasdaq under the ticker symbol BULL after completing a SPAC merger. Webull, which competes with established players like Robinhood and Charles Schwab, offers commission-free trading in stocks, options, ETFs, and cryptocurrencies. The stock experienced an extraordinary initial surge, jumping by over 500% in its first few trading days, reaching a peak market capitalization of nearly $30 billion. This dramatic rise reflects significant initial investor enthusiasm, reminiscent of the meme stock frenzy we've seen in the past. Webull has since experienced a significant pullback. While there's no single concrete reason for this volatility, it's common for newly public stocks, especially those that experience such rapid gains, to see profit taking by investors. That's it for this episode. It's been an interesting start to earnings week with tariff drama and a few antitrust cases. What are your thoughts on the earnings releases so far? How are you playing the tariff situation? Are you investing in ASML, TSMC, Google, Meta, or Webull? Let me know in the comment section below. And as always, if you found this video helpful, hit that like button, subscribe for more in-depth market analysis, and share it to your fellow investors. Thank you for watching, and I'll see you in the next one.